It does feel quite strange that the whole of crypto is set up to try and undermine existing systems that sit outside of crypto. But the most important instrument in the whole space is totally reliant on the banking system. And so we just thought it was important to create our own form of money. That's kind of what we view as like the holy grail.
Guy Young, the founder of Ethena Labs.
Ethena is a synthetic dollar protocol built on Ethereum that provides a crypto-native solution for money,
which is not reliant on traditional banking system infrastructure.
What's your biggest prediction for the next 12 months?
The BTC ETF was obviously a huge moment, and I think this entire cycle has basically been built around that single event. What happens if we start to see outflows from all those ETFs together? When interest rates eventually start coming down in the US, that's going to be a very interesting time for Ethena, because 90% plus of the transactions that you see on-chain and non-centralized venues have a dollar sitting on the other side.
What can go wrong in a cash and carry trade?
When you don't see a huge basis between the spot asset and the futures contract, people will do this on enormous amounts of leverage, so 20, 30, 40, 50x. With Ethena, the core idea and the philosophy is that we want to make this as safe and secure as possible. And Ethena doesn't use any leverage. The backing of UST was the Luna governance token itself. We've been very explicit that we do not want to attach anything to do with the governance token. We sort of see Ethena as the vehicle where those dollars from TradFi can actually come in and make those interest rates make a little bit more sense.
The lack of innovation in crypto is actually what led us to the meme coin mania. What are your thoughts on meme coins?
This might be very unpopular, but
everything looks really great now for Ethena. You came out of the blue and launched a protocol worth more than $10 billion within a year. But 1 year ago, everything was not fine. Why?
I'm Guy, founder of Ethena. Before I started out with Ethena, I was working in TradFi, sort of been around crypto since late 2019. And yeah, happy to sort of jump into Ethena, whatever makes sense on the side.
So everything looks really great now for Ethena. Obviously there is challenges, like with every company or protocol, but you came pretty much out of the blue and launched a protocol worth more than $10 billion within a year. And one of the things we talked about, right, was that 1 year ago, everything was not fine. Why?
As in the market conditions like a year ago? Yeah, I think it's interesting that I've always had the perspective that the guys who sort of like do the best when you're developing something or building something, it always has to sort of be anti-cyclical to the actual market itself. So I think anyone who did well last cycle, they were building things in 2018, 2019, and then sort of saw the rewards of that a couple of years later. So I've always been of the view, and actually when I quit my job to start doing what I did with Ethena, you always had to be doing that when you felt the market was basically at the lows or, you know, like peak pessimism around the market. That's when you actually have to build something. And then, you know, you pop out and everyone sort of thinks that it's like an overnight success when they see it now. But that sort of like took the work like a year ago when everyone didn't have like the view and the belief in what we're doing. So I think another challenging piece around the time when we came out was obviously just like the context of the product relative to what we'd seen in the last cycle. So it was a pretty outrageous idea, right, to come and say, we want to do something that's like innovating on stable coin like designs after what we saw with Luna. And then it's touching centralized exchanges and centralized infrastructure. And FTX was like the other huge like thing last year, right? So to actually go to people and try raise funds saying we're doing a stable coin like product on centralized exchanges, people look at you like you're completely crazy. But I think that's actually the nature of like a good investment or a good idea. It has to be sort of like contrarian in some way versus where the market's sort of sitting at the time. So yeah.
So you actually struggled a year ago to get even capital.
I wouldn't say
interest.
I wouldn't say struggled. I think it was just in the same way you see it as quite a divisive product right now, where it really splits opinion in terms of whether people think it's a worthwhile thing that should exist, or half of CT thinks it's sort of like the next Ponzi scam. It was sort of similar feedback to what we were getting a year ago when we were doing like the initial seed, where yeah, some people got it very quickly. We didn't like struggle to raise the funds. But like a lot of people just instantly were not interested just because of like, I think the headline risk around it.
So in The Big Short, Jared Venet says, the outsiders saw the giant lie at the heart of the economy, and they saw it by doing something that the rest of the suckers never thought to do. They looked. You told me that most of the people and VCs do not look beyond the current thing and into the future, right? So it happens in bull market, which is why we end up in tears every time. But it also happens in bear markets, which makes it both hard for builders, but also an amazing opportunity for those who look, which are not that many. And as we know now, a year later, Ethena was a gem that not many wanted to look at in the bear market. how should people and VCs approach gem hunting in a bear market?
Yeah, I think one, I guess, like pitfall that you see sometimes is basically trying to draw analogs to something that might have failed in the past for a very specific reason, and then writing off something new that might be iterating on that without sort of thinking about why it is actually different this time. So just thinking about maybe the example with Ethena, we did actually see two projects doing the same sort of design that we had back in 21. There's a project called Lemma on Ethereum and then another one called UXD on Solana. And a lot of people don't sort of look beyond just like the surface level of it's been tried before, why are we sort of trying this again? And I think that that's like a very sort of common mistake to not actually just look at something on its new merits and try to understand why is it that that builder has taken a view that what they're doing now is actually different to what was sort of tried in the past. So I think like Athena's product, it's not actually the first. Like people have tried this before in the past, and the people who I think backed us and sort of got behind what we're doing just really spent the time to think, why is this sort of like different this time? And I think that's why they were sort of like rewarded for what they did.
So what did not work out for these two other projects, and what are you guys doing differently that you think has made a big difference?
Yeah, I think it was. It's really just around scalability. So I took the view that these guys were building it all on chain, all on decentralized exchanges, and I just took the view that people care less about decentralization than we want them to, and you're always making some sort of trade-off in the design when you're choosing decentralization over something else. You're trading off whether it's scalability, efficiency, cost, whatever it is. And I just took a very strong view, like thinking honestly to myself whether I sort of care about those things with applications specifically. And we made an explicit trade-off to just say we want scale with centralized venues over like some of the theatrics that you see with like decentralized exchanges.
That's so interesting because it's just extremely practical, right? I had Lukanen just before in the studio, and he's also like extremely practical and doesn't really care about calling out kind of myths in the industry. And like you seem to be kind of similar in terms of like, hey, like everybody talks about decentralization, but like what works, what can we do? And let's just be practical and build something that's working.
Yeah, exactly. And I think it's actually, we've actually seen like the behavior of some of the OG builders sort of change in that regard as well. I think one of the more memorable meetings I've like ever had with Ethena was with Kane from Synthetics, where he was obviously like pretty much the grandfather of like DeFi and what he was doing with Synthetics. And he had like a very open conversation with me just saying, it's quite painful when you're a builder and you're building a product that you think other people want, which is like the decentralization piece, but actually only like 1,000 people out there like actually care. And even like what he's doing with his time now with like Infinex, which is again another sort of like C DeFi connection type thing. Again, it's sort of him just recognizing I want to build a product that people actually want to use rather than what like purists tell me that I should be doing. And so I think we have actually seen a bit of a shift in like builders' approach to just try to be more pragmatic, as you were saying. Because I think ultimately you never want to be building products that people just don't use. That's like the worst sort of outcome for everyone.
So what do you tell today to kind of decentralized maximalists, right? Because we really see in the space, you have obviously everything starts from Bitcoin decentralization, then you have the ETH maxi, and then you have Solana happening, and it's too centralized and it doesn't make sense, and so on and so forth. Like, what's your message to these guys? Are they completely disconnected from the reality? Are they focused on the wrong? Do they have the wrong focus?
No, I think it's a bit more nuanced. Like, where in the stack are you actually focusing on decentralization? So I think at a base layer, it's incredibly important actually. So like Bitcoin, Ethereum, all of that is incredibly important to actually have things decentralized at that layer. I think it's just more when you go one level up at like the application level, we all know that these things look and feel a little bit like normal businesses, right? They look like more like fintechs than they do like open networks or like base layers. And I think trying to solve too early for that decentralization piece at the application layer, I think is unhelpful in the beginning. I think you should always be looking for product market fit first and then walking back towards some of that decentralization pieces later. So it's not to say that I don't think it's important. I just think it's important at different levels to varying degrees.
You told me that you believe that most founders are very smart and that being on the right or more on the right of the bell curve won't make a difference. What's important as a skill for success to you? The most important?
Yeah, I think the comment I was making to you there is like we're all sort of within, if you just think of it like a normal distribution or whatever on a curve, we're all sort of like vaguely close together in terms of like I think your intellectual like horsepower. But the things that I've like personally just found from people who are like successful around me is just basically like grit and like not taking no for an answer and actually just pushing ahead with like more aggression than other people. And so I tend to think that the guys, or what I've seen from people who have done well around me, it's usually like the second smartest guy in the room who kind of does the best, where if you're the smartest guy and you're always told your entire life like you're the best, you're the smartest or whatever, you kind of get a bit lazy and comfortable in your own position. It's really always the guys with the chips on their shoulders who are trying to prove something constantly, who I feel sort of actually do the best in the end. So that's always just been something that I've personally been focused on, which is sort of work harder and have just like a bit of more of a grind than other people. And I think that that's actually more important than like on the margin sort of like intellect or being slightly smarter.
What's the risk for the smartest person in the room then?
I think just getting comfortable and lazy in your own position when everyone's always telling you you're the smartest dude or whatever it is. I think it's just getting comfortable, which is like the biggest risk.
Do you think it will happen in 2022? These guys blew up basically.
Yeah, I think so. Yeah, definitely. You get lazy, I think, with all the numbers going up and just assuming that you're, you know, God's gift to earth when everything's going up. And then you realize a lot of it was just leverage in the end.
Absolutely. You gave me the example of your ex-girlfriend, right? Who invested in Ethena, not because she understood crypto, but because she saw how focused you were. So it might sound like a simplistic investing framework, but often the simpler the better. Do you want to elaborate on that?
Yeah, it was just a funny story that she has like no connection to crypto whatsoever, doesn't follow it at all, and then heard that I was starting this out and wanted to put money in, and I was just like, why are you doing this when you don't even follow the space? And she just said, you're a bit of a psychopath where you don't want to be, like you just don't want to be a loser, basically. And that was her just entire investment.
A psychopath in what sense?
As in like you just...
Like you just focus like crazy on your thing and nothing else can deviate you from your mission or your focus.
Yeah, exactly. And
not even a woman beside you.
Yeah. So yeah, she basically just said like your ego was like enough that you would never not let it work out, basically.
Ego.
Yeah.
Is ego a good thing or not? I had Jordi Alexander on the podcast 6 months ago. He said he had this big problem with his ego, and it really, until he solved it, it was really a bad thing for him, and that ego is one of the things that kills your potential the most. What do you think about that?
I think it's actually like a really fine line for founders because there's a natural arrogance, right, to starting something because like the nature of what you're doing is saying the world has a certain view of things and I think that they're wrong and I'm going to go and build something that looks different to the way that the world looks right now. And so that's an incredibly arrogant thing to even think, right, that you can go out and do something that the whole world thinks doesn't make sense or is like a low probability outcome or whatever it is. So I think you always need a bit of like arrogance to sort of back your own idea to tell the world that they're wrong with what you're building. But then like there's a very fine line obviously to taking that too far. And I think a lot of the behavior that we saw last cycle with the Do-Kwons and stuff like that was just a very ugly example of people, I think, just being too sort of caught up in their own ego. So it is actually a very fine line, I think, to sort of walk between having confidence in yourself and not taking it too far.
Every week, I sit down with the biggest builders, investors, and traders in the crypto industry for a 2 hours long conversation on my podcast, When Shift Happens. I had most of the biggest people in the crypto space in this studio. Arthur Hayes, Jordi Alexander, Ben Zhao from Bybit, Miao from Jupiter, Luke Belmar, Luke Annette, Schioni from Monad, Guy from Ethena, and the list goes on and on. Every podcast is recorded in studio and goes into my guests' life, childhood, anxieties, and biggest struggles, as well as successes, which enables me to build a very close relationship with each and every one of them. This, in turn, allows me to get the best alpha and private deals directly from the big builders before anyone else. Today, I'm announcing that I've teamed up with SwissBorg, the largest European exchange, to bring you the best alpha deals directly from the best builders and investors in the crypto space. We're doing this through an exclusive investment club called the Kevin SwissBorg Investment Club, which is accessible only via the SwissBorg app. What can you expect in the Kevin SwissBorg Investment Club? Exclusive access to only the best alpha from the best builders in the space before anyone else, and
exclusive private deals that are filtered by the SwissBorg investment team and that are sourced directly from my behind the doors conversations with the crypto kings and queens. I have to say, this is not about random projects to buy or trade every day, but rather to focus on a few key projects, airdrops, and deals that can really move the needle and help you master the crypto game over the next 5 years, not 5 weeks. If getting the best alpha from the biggest builders in the space before anyone else and accessing some of the best private deals in the space sounds like something that would add great value to your investment journey, you can check the first link in the description down below. And now back to today's episode.
You have a pretty boring routine during the week. You wake up every day at the same time, go to the gym at the same time, eat the same thing most of the time. Why is having a boring routine so key to be great at what you do?
Yeah, I wouldn't say it's like a necessary condition, but I just find personally myself that like putting structure around things is just helpful when there's like so much to do the whole time. So I just personally find, waking up at the same time, eating the same thing, it also just reduces like the brain power that you're putting into planning these other things. So it's just like, you know what it's going to be. You don't have to spend time thinking about these other things. I've just personally found that sort of having that structure in my life helps me keep it in order.
So you mentioned Dokun a couple of times. So I had Dokun on the podcast late 2021. I think it was October. And what we did was, I was just thinking, everybody wants a very technical thing in the community, right? But like, how do we introduce more people into crypto? Let's do a stablecoin masterclass. So we basically did a stablecoin masterclass explaining the 3 types of stablecoin back then: centralized, decentralized, and decentralized algorithmic. Can you briefly, very briefly, go through the 2 types of stablecoin that survived the last bear market?
Yeah, I think just the normal fiat stablecoins you'd be used to, like the USDT and USDC. Very simply, it's just taking a T-bill or a bond or a repo. It's sitting in a bank or an SPV, and you're just issuing a receipt token against that. Pretty low risk, I think, in the way that they've been set up now, and they're getting less risky the way that they're sort of constructed.
I mean, we still saw the USDC depeg with the banking crisis, right? Which we thought would never happen.
Correct, and it was an interesting point because I think people like viewed USDC as basically risk-free, and people like learned that actually there's custodial risk with all of these things. It's just a question of where is that custodial risk actually sitting. So I think for us, again, that's probably the biggest risk with Ethena, which is like you've got crypto assets sitting with custodians and exposure to centralized exchanges. That doesn't mean it's like better or worse than having your assets sitting in SVB. I think the powerful thing to us is that it's different and it's uncorrelated. And that's actually quite important because as you picked up on that one weekend, if you remember, all of the other stables traded down in lockstep with USDC. So like MakerDAO and Frax on chain went down to the exact same price. And that's because the market, it was obviously MakerDAO had some USDC sitting behind it. And everyone looked at that and said, actually, all of these things have the same risk profile, which is like the actual assets are sitting in SVB. And so we thought that that was a fundamentally important thing to try and provide something that was like truly uncorrelated to that kind of risk.
Which is where this thing you call the synthetic dollar comes into play. Why is a synthetic dollar so important in DeFi?
Yeah, well, I think at a very basic level, stable-like assets are clearly like one of the few things that have actually found like product market fit like properly for like a non-speculative use case, I think, in crypto. And it's sort of like the lifeblood of all of these applications, right? So every DEX, the highest traded asset is always $1. Every perpetual DEX uses like dollars for collateral. Money markets, it's all about borrowing dollars. All of these things run on dollars. Like 90% plus of the transactions that you see on-chain and non-centralized venues have $1 sitting on the other side. And so given that, it does feel quite strange that the whole of crypto is sort of set up to try and undermine like existing systems that sit outside of crypto. But the most important like instrument in the whole space is totally reliant on like the banking system. Like that whole thing doesn't make sense. And so we just thought it was important to create our own form of money. That's kind of what we view as like the holy grail as an app.
Can you elaborate a bit on, again, like, I think you're different than like Lucanets because you're really practical and you're really telling what you think, which is here. You're saying, except speculation, there's not much innovation, except stable coins, right? Stable coins, you could say cross-border remittances, or even store of wealth in certain developing countries that can have access to a dollar. Because if you need to explain Bitcoin to a developing country and like still goes up and down, and obviously exchanges make sense as a business because they make a lot of money, right? But like pretty much everything else is purely speculation still, right? And I got grilled on Twitter by some guys who are saying, yeah, you don't understand anything. And then he listed a lot of things like atomic swap, decentralized exchanges. And obviously I'm aware of that. And obviously I think it's great, but like, what are all these things used for? Speculation.
Yeah.
That's it. Like, let's be very honest. So what do you think about that?
I didn't actually view speculation as like a negative thing to start with. I think it's always like portrayed as this negative criticism of crypto, that it's like all about speculation. Obviously, you want it to be doing that more than just that. But I've actually found that like speculation, even in my own life, is actually quite like, it's a form of entertainment, firstly. And like if you compare all of the things that we do in our spare time that are actually quite like destructive to ourselves, like gambling on sports, going to casinos, drinking at pubs or whatever it is, this is actually something that like brings you and your friends together, and it's actually something that you spend time like talking with them about. So if you remember during COVID, all we were doing was sitting down Robinhood and like punting shitcoins in crypto, but it's actually something that like you sort of did to, you know, like pass your time. It's like it's something that you're actually using as like entertainment. So that's actually, I don't view it as like a net negative thing always. And then the other thing I think that's like interesting about it is that it also like forces you to educate yourself around things as well. So I think the amount that I've sort of like read about where it's like history of central banking, like banking systems, all that kind of stuff, that happens when you make an investment into something and want to actually like learn a little bit more around it. Same with like investing into a company where you might go understand like how does Nvidia work, how does Tesla work, all that kind of stuff. So I think like actually speculation, it's not necessarily like a bad thing. I do think it is quite disappointing though that like after 10 years in crypto, this is kind of where we're at, which is like big casino and then stablecoins is kind of what I view as like the two sort of like outcomes.
So let's talk about this synthetic dollar. And there is enough podcast talking about very technical things. So let's try to keep it as if we're talking to our mother here. How is the synthetic dollar created?
Yeah, so very basic level, you've got a asset that's coming in. It can be Ethereum, Bitcoin, other type of crypto assets, anything that has like a derivative market that sits around it. And the basic idea is that you're putting down that collateral and then taking out a short on the other side for the same sort of size. And the idea here is that if the price of the underlying asset is moving up 10%, down 10%, those two sort of positions are setting each other off perfectly. And so the idea is that when those two things net off, you can issue a stable like asset against that. And so at a very basic level, all Athena's doing is taking in assets, a mix between BTC and ETH at the moment, and then immediately hedging it on the other side, and then issuing that synthetic dollar against that position. What's interesting and what falls out of that is like, are you capturing an interest rate normally? So you might see people talk about funding rates, and I don't know how much detail you want to get into that, but you can sort of just think about it as like this is the cost of capital, like interest rate within crypto to get your hands on dollars. And really Athena's just sitting on the other side of people who want to long crypto and collecting an interest rate from them. Yeah.
So on these centralized exchanges, you have a market, derivative market, where there's people who long and there's people who short. And the funding rate or the funding fee is basically there to incentivize the longs and the short to be kind of equal and not have too many people who are taking one side of the bet versus the other. Otherwise, there's a problem, right?
Yes, exactly. So it's there just to bring the sort of like derivative contract and the underlying spot asset in line.
So I think that's simple enough. Can you explain the cash and carry trade?
Yeah, it's basically that is, it's putting down the spot asset and then shorting the future, or in crypto, like the perpetuals are a bit more popular than like dated futures. But this is something that you see in the real world the whole time across commodities, bonds. People have been doing this for many decades. It's just within crypto, we're sort of tokenizing it for the first time at scale. And I think the interesting thing is that in the real world, you're obviously never paid an interest rate that looks anything like what you see in crypto during bull markets. And typically that's because you just have this huge like imbalance between the capital that's actually supplied to crypto and how much the crypto market actually wants. So traditional pools of capital, we continue talking about like the institutions are coming and all that kind of stuff. they're obviously like for the first time like really dipping their toes now into owning BTC through ETFs, and I think that obviously continues going forward. But like TradFi supplying dollars into crypto, I think we're still like at the very early innings, and we sort of see Ethena as the vehicle where those dollars from TradFi can actually come in and make those interest rates make a little bit more sense.
What can go wrong in a cash and carry trade?
Typically when it's gone wrong in the real world, like outside of crypto, it has a lot to do with like leverage. So when you don't see a huge basis between the spot asset and the futures contract, people will do this on enormous amounts of leverage. So 20, 30, 40, 50x on like treasuries, for example. Here with Ethena, like the core idea and like the philosophy is that we want to make this as reliable, safe, and secure as possible, and not like eke out every little piece of like return that you can. So Ethena doesn't use any leverage on the cash and carry. It's just a spot and then 1x short on the other side. That's not to say that there aren't any other risks that exist, but I think a key thing that usually goes wrong here is when you're making some assumption on how the spot and the derivative contract will interact on leverage, and when those two things sort of like don't work out in the way that you expect on leverage, that becomes an issue.
One of the big red flags for UST, so in the Luna case, right, was when UST market cap became larger than Luna. That was very shortly before, or when Luna started to go down enough so that then you have this big mismatch. What's the USDE? So your synthetic US dollar. What's the USD size at which it becomes too big?
Yeah, I think the rough way, and just to be 100% clear here, the Ethena like governance token doesn't have any role to play within like USD itself, and that's like a very core difference. And when people are asking or comparing it to Luna, that was really like the backing of UST was the Luna governance token itself. We've been very explicit that we do not want to attach anything to do with the governance token to the actual like asset itself, and they are like functionally separate. The way we sort of think about the max market size here, it's not really like a demand side issue, I think, with Ethena. I think the demand for like $1 with a yield above treasuries is hundreds of billions of dollars. It's not like 1 billion. And so I think finding people who want that as a product, it's one of the easiest products in the world to sell. The question is actually around like the capacity for crypto to, in the derivative market specifically, to allow us to get to 10, 20 billion dollars in size, like you saw with UST. It's really a constraint around how much outside leverage is there or demand for leverage to be long crypto on perps. We can never be bigger than that amount, right? So the constraint is how much are people using perps within crypto. We sort of think about it as like a very rough number of roughly 30% of like open interest within the market is a bit of constraint and ceiling for how big we can get. Roughly at the moment, you see around $30 billion of open interest for majors. So like at the moment, if the market didn't move at all, I think 10-ish billion is sort of where USD starts to come into some real constraints.
So basically, you're able to control the cap of USDE and saying, hey, like, sorry, we can go higher than that as long as the market is not higher.
Yeah, I think
to limit the risks.
Yeah, we as a team, we can't like ever fully cap it because it's going to be a free market of people sort of coming in and out, but it does have an interesting sort of like self-regulating way of making sure it doesn't get too big itself, because the larger that USD gets, the more we push down funding rates as a protocol. And so when the interest rate, I don't know if you were looking at Athena, when it first came out, it was like 35, 60, like that crazy level. Obviously, as Athena grows, we're putting more and more short interest into the market, which brings that interest rate down through time. And naturally, as that interest rate comes down, people find the product less and less attractive, right? So I think as Athena grows, we're going to be pushing down the interest rate, which makes it less attractive for people to come in. And so I sort of view these things as market set interest rates that we don't want to be stepping in and trying to control in any way, which I think was like a huge mistake that we saw with Anchor, specifically around Terra. And we're just putting the infrastructure in place so that we're allowing the market to just find out what is that clearing level of interest rate.
And that's also where you test whether people are here for the product, the synthetic dollar that they think is really useful, or they're there for the yield, right?
Yeah, exactly. Yeah.
Mark Twain said, and this really resonated a lot with me after the Luna crash, because I was a big Luna holder actually. It ain't what you don't know that gets you into trouble. It's what you know for sure that ain't so. What do you know for sure that might not be so?
Yeah, I think specifically with the Athena risks, yeah.
Actually, let's do it both. For Athena and then in life in general.
The life ones, that's too difficult. So on the Athena one, I think we do like generally have our arms around what we think like call it like 4 to 5 key risks are, and obviously we've had a lot of people chiming in from the outside in to express their views on what that actually looks like. I think the one which is maybe like a little bit under discussed or less understood is like actually the idea that when we're short on those contracts, you need someone on the other side to actually pay you out, right? Your counterparty can't go fully bankrupt. And this is how a centralized exchange is sort of managing the risk engine internally as well. Something that we did used to see before, like the last cycle was back in 2018, like ADL events where actually you don't get paid out on the contract in the same way that you thought you would. This sort of happens when you see like true market completely, wipeouts across the board, and you can't actually like collect the P&L that you thought you should be getting on the other side. That's one thing which we haven't like seen for 5 years in crypto, and I think people have sort of like forgotten about it because exchanges have got bigger, better capitalized, the assets are lower volatility and that kind of stuff. But that is one thing where we haven't sort of seen it at scale on BTC and ETH, an ADL event, and that's sort of something which would be quite concerning for Ethena.
Ladies and gentlemen, I'd like to take a short moment to introduce our partner, Mantle, who helps us make this show possible. Mantle was created to hyperscale the Ethereum network with what we call a layer 2 that helps users like you and me transact much faster and at a fraction of the cost of the Ethereum network. Mantle has over $2 billion in total value locked, has a mega treasury of $3.7 billion in Bitcoin, ETH, and stablecoins, and has the largest eco fund of the industry with more than $200 million to invest into new projects that want to join the Mantle ecosystem. The team behind Mantle are extremely smart people who I personally trust with some of my money and who I personally know outside of crypto. We actually had Ignace Ternus and Jordi Alexander on this podcast, who both are key figures in the Mantle ecosystem. So I invite you to watch these two very candid and in-depth conversations to develop your own opinion. And please, 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 if you enjoy this show, hit the like button, leave a comment in the comment section, and subscribe to this channel. The more subscribers, the better the guests. Thank you so much for your help. And now on to today's episode.
What do you think would happen if we had a COVID crash,
Yeah, so even on the COVID crash, we didn't see ADLs even during that. So really what we're talking about here is like even orders of magnitude worse than that. And the market's obviously more mature than it even was back then in the beginning of 2020. So, yeah.
What was a worse event than COVID March crash?
Yeah, I wasn't even around for this stuff in 2018. Yeah.
Because that was pretty bad. What's the absolute worst thing that could happen to Ethena and USDE?
Yeah, I think it's actually the same sort of risk that you saw with USDC with SVB, where we haven't got T-bills sitting in a bank, we've got crypto assets sitting with custodians. And if there's fraud or like just a loss of the underlying assets in those custodians, that's like how you like truly lose like the backing of USDE. I think the other risks are like more on the margin, where there could be issues like at 98 cents, 99 cents versus $1. The one where you like truly see a wipeout of like the collateral backing is always going to be if like the actual underlying assets are sort of affected. But this is the same as like a smart contract, right? Like for any DeFi project, if you have a smart contract hack, that's basically like the end of what you're doing. I think it's basically the same kind of risk that sits here.
Probably the smart contract hack is still higher. If you look at all the hacks that happened in the last couple of years.
100%, yeah. Yeah.
To be very practical, yes, centralization is not great, or you basically giving your trust to some people, but like there's been so many hacks in the decentralized space that DeFi space that definitely we're still at this point where we're not really. I mean, we're criticizing centralized parties, but what's the other alternative, right?
Yeah.
You said you were pretty underwhelmed with the level of innovation we've seen in DeFi in years. And I had Daryl Wong from Tangent on the podcast maybe 2 weeks ago. One of your early investors who said also the same. He said that the lack of innovation in crypto is actually what led us to the meme coin mania. What are your thoughts on meme coins?
I think they're good and they should exist. I think it's not only a response to a lack of innovation on like more serious projects, but I also think it's a response to like the market structure changes in the way that like VC funding and like the way that launches have been going recently as well. I think the way that the market is set up now, and there's a bunch of regulatory reasons for why this is the case, but it's sort of like progressively got worse, I think, over the last few cycles, where now it's quite difficult, I think, for retail to get any exposure to something before it's like a multi-billion-dollar project on a centralized venue. That's something that there's been a few new projects that are coming out to do, like call it like compliant ICO type things, and I think that it's actually a very helpful change in market structure if they can do that right. It'll be one of the most important things that comes out of the cycle if we can get back to that. But I think actually the meme coin response is also just a response to, I don't want to be buying a VC's bags at like a huge markup from their investments the whole time. I want to like participate in something that's early and it feels like more of a level playing field.
What does the Holy Grail look like for Ethena?
Yeah, I think for us it's pretty simple, and I mentioned it earlier where I think creating our own form of money is always the holy grail of anything within crypto. It's always like even BTC sort of started out with that original vision and then sort of landed on something that was a bit more narrow as like a store of value, but like money was like the original thing that I think got people excited around that. Even ETH, if we think about like the monetary policy around ETH and like the meme now of ETH is money, all of these things converge to money at the end because people recognize that is the holy grail in and of itself, is becoming money in some way. And I think we just have a recognition that we can talk about these things as money, but people don't use BTC, they don't use ETH as money, they use dollars as money. And we think that creating our own form of money within crypto is one of the most powerful things that you can sort of work towards.
You said you were willing to share some of the roadmap for Ethena. What's your vision for the next 12 months?
Yeah, I think for us, the initial rollout was like very much focused on like apps within DeFi. So you might have seen us like integrated on a few of like the money markets, different stablecoin projects, that kind of stuff. I think the next phase is actually something that's ignored by previous projects who have done stable-like assets on chain before, which is actually thinking about CeFi as a distribution channel and like a big area for growth. So a lot of the like a DAI and Maker and stuff, for example, have never really pushed into CeFi in any material way. A big sort of like key vision of what we want to do here is actually provide neutral infrastructure for all of the centralized exchanges in the space to feel like they want to push this product to their own users as well, and just set up the right incentive structures around the product so that they feel incentivized to do it. Because I think there's generally a feeling amongst centralized exchanges that they provide all the rails and the success for something like Tether and Circle, but they don't see any of the return that sort of comes through, in terms of like the revenue sharing and that kind of stuff. And I think that there is a big opportunity there to basically align the exchanges with incentives and actually have them like distribute to their users on the other side.
What does that mean? Does it mean it's more of a kind of marketing and incentives push effort, or also on the product side, hey, we're going to offer this and that and some new things?
Yeah, it's 100% on the product side, less on the marketing. So one clear example here is there's about $20 billion of Tether used to margin linear perpetuals on centralized exchanges. So that's like that as an opportunity just by itself is like enough for Ethena to just target that one use case, which is putting down USDE, collecting a yield while you're trading a perp on the other side to sort of offset your funding costs. And if you go to like the biggest trading firms in the space, that's a really big deal that you're missing out on like 10, 15, 20% on the collateral that you have down. So we see that as like a huge opportunity there to basically use USDE as perp margin collateral. And we'll have a pretty cool announcement on that basically next week with one of the major sectors.
As you said in the beginning, you built a pretty controversial product. Controversial because it's a mix of the things that blew up in 2022. A synthetic dollar, which Terra tried to build as the UST stablecoin. And you're doing this through centralized exchanges, which one of the biggest one was FTX and also blew up, right? Why would we go back to stable coins and centralized exchanges after being completely traumatized a year and a half ago?
Yeah, I think it maybe gets back to the same comment I was making around the like VC mindset, where you sort of dismiss things from the past that haven't worked and don't try and reevaluate it like going forward. I think the reason that people got behind the idea of like Terra and Luna in general was it was a big idea, right? And it's something that clearly people want to see succeed. And I don't think it should put people off if someone has done it in the wrong way in the past. Doesn't mean that you should sort of like give up on the idea going forward. So yeah, that was just my view that it was an important product that should exist. And even though previous iterations hadn't worked, didn't mean that it wasn't like worthwhile pursuing again.
Ladies and gentlemen, as you probably know, we are teaming up with Astar Network on this show. Astar Network is a decentralized blockchain platform that aims to bring billions of people into Web3. And the Astar team has a very specific strategy to make this happen, to partner with the biggest conglomerates in Web2 and help them onboard their customers into our world, the Web3 world. If you want to check out for yourself, I invite you to watch the candid podcast I recorded with Sota Watanabe, the founder of Startail Labs and Astar Network. And please, 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 if you enjoy this show, hit the like button, leave a comment in the comment section, and subscribe to this channel. The more subscribers, the better the guests. Thank you so much for your help. And now on to today's episode.
I have a question from Yatsu, the founder of Animoca Brands, who was on the pod 2 days ago. Here's a question for you.
Okay.
From him, why would a stablecoin need to be backed by ETH?
Yeah, it doesn't need to be. I think there isn't like a specific reason around the actual backing that's sitting in there. It's really because we're neutralizing the price of BTC or ETH or whatever goes in there. It could be Solana. All we really need is a deep derivative market that sits around it. And so obviously ETH has the second largest open interest in the market. And yeah, it's nothing like driven specifically around ETH itself that sort of needs to sit in there.
What's another architecture for a synthetic dollar that you could think of that could potentially work?
Yeah, I think depends how you sort of define the CDP stuff that you see with Mako, but I think that there is some more experimentation that you can see around that, where essentially what you're doing is putting down collateral and then borrowing against it to create the stablecoin into existence. That actually isn't like that different to what Ethena is doing, but instead of hedging like the ETH that comes down as collateral, what they do is they leave a big buffer between the collateral value and the debt, so that when the price falls, there is like a bit of a buffer. So like conceptually, they're not actually that sort of far apart. And I think that there is like an interesting design space between what Ethena is doing, which is essentially $1 of collateral comes in and one stable asset comes out the other side, where Maker is like $2 go in and then you borrow $1 on the other side. I think that there's like an interesting middle ground between the two where we will see some experimentation going forward.
So you're building a controversial product, and obviously it doesn't come without a healthy or not so healthy dose of criticism, right? And you are handling this sometimes really harsh comments in a very chill fashion. Why?
I just have confidence in my own that my heart is in the right place, basically. So I think it stresses you out when people are calling you a scammer and stuff when you think that you are. But I sort of have confidence in the way that we've been transparent around the risks and stuff from the beginning. And I think my approach to this whole thing has always been we shouldn't shy away from these criticisms and the engagement that people have. I think it was one of the biggest mistakes that we saw from some of the founders of last cycle, which was basically dismissing people that were actually like raising valid concerns. And it's just an approach that I've always had, which is I actually always want to listen to people who think that I'm wrong, because I actually, if I do think I'm wrong, I want to work that out early and make a change early, rather than something happening when the problem is much bigger further down the line. So I've always just actively sought out criticism, and it doesn't mean I always listen to it, but I think it is like a healthy thing to do.
How do you deal with FUD? We had there was Meow on the podcast today, and the Jupiter launch was very controversial also. And he was very affected by it. And he said, for example, for him was like, man, if I see like massive FUD, I just go to sleep. Because if I'm not in a good mental space, I can't handle, I don't make the right decisions, and I'm going to start to be maybe more aggressive. So how do you handle that? Do you just go like smash a workout, or do you just go to sleep, or you just like build different high testosterone? It's fine. I'll just answer, chill.
No, I'd like to pretend that's the case. Definitely not. No, I think that I definitely had like a bit of a shock on the first week, because we'd sort of done a bit of a pre-testing with the product actually with like 100 people before we fully opened up to the public. And like your first 100 users are all fans usually, right? It's like, oh, this is a cool idea, cool product, which is like nice feedback to hear. But then the second you like fully open up to the public and you move from 100 people to 100,000, and half of those 100,000 think that what you're doing doesn't make sense. That was like pretty difficult actually to like hear on the first week, because you just weren't used to people like not liking the idea. But yeah, I think you just get used to it, and I'm not that affected by it now. When I see criticism out there, I think just try and find the ones where you think it is valid and you come back and give people reasonable responses, and then just try block out the stuff that you think isn't sort of fair.
And back to what you said before with the ego thing, right? If you have the ego or the audacity to think that something that basically we're going to build a business that the majority is not built yet because the majority of people don't believe in it. You can't expect that from one day to another, if you bring it to life, everybody's just going to agree with it. It's part of entrepreneurship in general. There's always going to be people who kind of hate. It's life.
Yeah, exactly. Life. Yeah. And that's the nature of doing something new, because everyone wants to start on the assumption that it doesn't make sense or that it shouldn't exist because it's new and they haven't seen it before.
You're creating a synthetic dollar, and you kind of came out of the blue within a year, right? And launched a protocol worth tens of billions of dollars. So there's a lot to be admired about that, about these achievements. But there could also be a lot to be feared as a founder. And I have a lot of founders on this podcast who maybe they just say, some they just say it on the podcast, some they say it, after the podcast, that there is a risk to be a crypto founder. And even more so if you're trying to build a synthetic dollar when you have the USA and the authorities that are basically, it was not on this podcast, but Do Kwon, he was saying, I think it was on the DeFi podcast, he was saying, I'll just own he was joking about it. He was like, I just own a bike, but they can come after me. I don't care. We're ready for the war. But obviously you don't want that. And the day it's happening, you taking it, you're not as chill about it as he was, right? How much do you think about this personally? And more generally, how risky is it for crypto founders who are bringing big innovations that might fail and make people lose a lot of money?
Yeah, I think just more generally, that is one thing that looks different with financial applications versus infrastructure. If you're building a piece of infrastructure that no one uses and they're memeing about 8 users on some chain or something, everyone just laughs and you're like, yeah, that's funny, it's a ghost chain, and we move on. But no one's lost money and it hasn't affected someone's life. That is a negative piece actually around building financial applications, which is it's real people's money that's in there, and you need to take that seriously, take that responsibility very seriously. And so it is something that you think about as a founder, where you feel an immense amount of responsibility to make sure that you've done everything that you can to make sure that people aren't losing money. But it is, as you said, the nature of innovation, which is we're trying new things, we're on the frontier, and trying to push the boundaries going forward. Sometimes even with the best intentions, that doesn't sort of work out. I think the key difference though is, have you been honest with people and you're not fraudulent in the way that you've actually presented these things? I don't think even Luna, for example, you can try this experiment. If it doesn't work, it doesn't work. I think the real core issues is when you're lying about chai and you're lying about usage, fraudulent to investors, fraudulent to users when you're saying that it repegged with natural market forces rather than what was going in the background with market makers. That's actually the core piece of fraudulent behavior, which is not acceptable. I personally think that experimentation around designs and stuff, if you do it in an honest way and it doesn't work, it isn't something that should be sort of frowned upon in the same way.
You said on another podcast, attention is the only scarce resource in crypto. Can you explain what you mean by that and how you used your understanding of the attention economy to perform one of the most successful token launches in the last few years?
Yeah, I think it's just because so much of crypto is never really embedded in fundamental analysis or tied to anything that's fundamentally real, all of the valuations or the way that things trade. It's really just around mindshare and how much mindshare you can capture from people. Now that there's so many different pockets of crypto, whether it's NFTs, AI, there's so many different areas that are constantly trying to grab your attention. It's how are you going to stand out and be at the top of people's mind the whole time, which is kind of the valuable piece, I think, to get people interested in what you're doing. I don't think there was a specific approach or strategy that we had around this. I think because the product was actually quite controversial and divisive, people sort of did your marketing for you, right? Because everyone had an opinion on Ethena. The whole peanut gallery, it was either yes, I think it makes sense, or no, I don't. But no one didn't have an opinion on Athena. And so we're sort of sitting back and like people are talking about it constantly. And I think if you're responding to it in the right way and just saying, I understand your concern here, your criticism or whatever it is, what else can you do on our side other than doing that? And so I think it was really like the controversy of the product itself, which forced other people into sharing their views and sort of grabbing people's attention without us having to do, I think, that much on our side.
Another thing about this super successful token launch is how do you create a big hype around your token launch that is sustainable and doesn't result in a big pump and dump, especially when you launch at such a high, fully diluted valuation, right, out of the gate?
Yeah, so to be clear on like the vows when they come out, we obviously have like no control around like that as a team. That's obviously set like externally by the market when it does come out. I think the only bit that we can do, and I think the bit that we were actually very focused on, which people did recognize, was actually not dragging things out with your users and sort of like farming your users. I think one thing that we've seen recently with this whole points meta and like basically just developers like allowing this thing to go on for like a year or 2 years without giving any clarity to users around what's sort of coming at the end. People, I think, are just so fed up with this now, where they were completely shocked that we came out and we said, we're going to do this quickly for like a month or two, and if we hit like a certain amount of TVL, that's going to be the end of this whole thing. And we just did what we said, and everyone's like completely surprised. And I'm like, is that the standard that we're sort of going for in the space? Which is like, the team didn't lie to me is like the base level of expectation. So I think it was basically just not screwing over your users, and that was sort of your supporters from day one, which is like the most important element of that launch.
You did a pretty generous airdrop. Do you want to talk a bit more about that? Like, was it completely planned, or like how did you think around that? Or you were again just thinking, oh man, everyone is, I mean, now is the points, right? A few years ago it was other things. There's just always another invention in the industry to basically get your liquidity. You're just thinking, oh man, like everything is so confusing everywhere. Let's just do something very simple and reward people handsomely just because they trust us. Or what's the approach there?
Yeah, I think, and this is just another conversation that I had with Kane before in the past, where I asked him how he built such like a cult following around synthetics. Like, what was it that actually got that community like going in the beginning? And his response was basically just like, you need to make people like really rich, and then they sort of get behind your project. So I've always been of the view that like if you are someone like a user who, you know, did the thinking, did their own work around Athena when everyone was flooding it on the timeline, you believed in us and like you put your money into our protocol and gave us your trust. And I've always felt that you just should be rewarding people who are sort of there in the beginning to help. And so yeah, we took Kane's advice and just did what we can to make people hilariously rich in the beginning.
Why do you think there's so many other projects or founders that are not following that? Is it because they're struggling? They don't have the luxury of doing that, or is it because they don't really know what they're doing, so they're like, oh, let's just keep this liquidity as long as possible, so let's just invent this point system and its things, or is it another reason?
Yeah, I'm quite strongly of the view actually that like there's like a strong negative correlation between your own confidence in your product and how long you're sort of dragging things out with your users, because a lot of these like teams are basically using this points meta as like a way to get inorganic traction and then go raise another round and raise another round with VCs. And like there's this whole sort of like game in the background that's going on where I think if you don't have confidence in your own product, the scary bit is like you drop the token and then everyone just leaves and goes and does something else, right? And you realize this wasn't product market fit, it was just points farming. So I was just strongly of the view that we needed to learn quickly if we had product market fit or not. And the quicker you ripped off the Band-Aid to sort of work it out, I think better.
So for you, this point thing and this kind of gamification of like usage of the protocol before the token launch is actually a red flag, right?
I think
in most cases, probably not all of them, but
I think it's actually extreme. It is actually really useful in one respect, which is you can actually get feedback from your users as you're doing it to like iterate on the product. So if they're responding to something in a way that you'd like, you can sort of like adjust that going forward or in the opposite direction as well. I think the only bit that's just we need to do better as like teams is just be clearer with people up front in terms of like here's roughly how long we're expecting you to be part of this, which I don't think is like an unreasonable thing to be communicating to people. And I think just being a bit clearer with users where you're not constantly feeling like you're extracting as much as you possibly can from them, and just trying to, I think, lay things out in a more clear way.
We have a a part of this podcast I call Crypto Alpha, where I ask builders about their favorite 2 or 3 teams in the space. So we're not talking about, hey, what coin should you buy, but more, who are the teams or projects that you like the most and why?
Yeah, I think 2 probably come to mind. One, PENDLE, I think, is like a really good example of a team who...
Do you want to explain what PENDLE is, what they do, and why you like them so much?
Yeah, so at a very basic level, it's like a interest rate trading protocol. That was like the original idea, but it's sort of morphed a little bit now to essentially you can buy points from people who want to sell it, and they're getting like a fixed yield in return. While if you're buying the points off someone else, you're taking like what is an extremely speculative sort of forward view on that project. And so you can just think about it as like an interest rate swap protocol, basically between fixed and floating yields. The reason I like them a lot is basically I think they'd struggled in the beginning to get product market fit, like at the back end of last cycle, and they're just one of the best examples I think of a team who just continued grinding at like the bottom of the bear market, like despite not having that traction until they did find it. And I think it's like if you just look at the chart of PENDLE, it's one of the best sort of reflections of that, where it's sort of down and then just this incredible hockey stick that sort of came back through time. So I've always just looked up to them in the last few months as just a team who just had the right attitude of like continuing through the bottom of a bear market to find things, like find product market fit on the other side. Yeah.
What's the other one? Said there's 2.
Yeah, I think the other one that I've just been impressed with is like the professionalism and approach that they have is a Mantle, the layer 2. Yeah.
Interesting. I mean, interesting now because I know like you did this big partnership. Actually, I think Ignace is the one who introduced
Yes,
this.
yes,
Cool.
yes.
So what do you like about the Mantle team and what they're doing there with the layer 2?
Yeah, I think it's just actually their approach, because I think some of the new layers that are coming out now have got this like ultra aggressive way of getting to market like as quick as humanly possible, and I think taking some shortcuts. I think just the approach that they've had, which is like quite thoughtful through time to say this is actually the type of application that we want to see come onto the chain. We want to support them in multiple different ways. They've obviously got a huge treasury, which they actually use to sort of support projects from like the ground up, which is like a huge boost for someone who's sort of starting from zero. But I think it's actually just around the thoughtfulness that they have, like looking forward in time and saying, what are the types of applications that we actually want to be here? And like, let's start planning for that now. And I think it's just in a bit of contrast to some of the more aggressive teams who just seem to be wanting to do things as quickly as humanly possible now. I just like admired their like thoughtful approach to things.
Shout out to Mantle, who is a partner on this podcast. You train 6 times per week in the gym. You told me 5 to 6 times.
Yeah.
Why?
It's actually more of like a mental thing, I think, for me, where if I basically don't go, it's like just sitting in the back of my mind, and it's become just such a routine and habit for me where I find like I'd really struggle to focus on something else if I haven't gone and done that at the beginning of the day. So I think it's less around the physical piece of it now. It's just more of like a tick the box exercise.
Absolutely.
Yeah.
The physical is a good side effect, but there's quite a lot of people who say, oh yeah, you're kind of narcissistic, you go to the gym. Like, no, I need that, otherwise I'm going crazy.
Yeah.
Like,
Yeah.
Do meditate, do something for your mental health.
I
the
don't
gym
know.
is like an enough.
Yeah,
enough for you.
that's basically it. Yeah. Yeah.
What's your biggest prediction for the next 12 months?
I think we're like in a super interesting bit of the market where we're sort of lacking that catalyst that we're all looking forward to and can sort of like speculate ahead of. So I think the BTC ETF was obviously a huge moment, and I think the real risk around that is actually that this entire cycle has basically been built around that single event. And it's quite concerning, I think, to think what happens if we start to see outflows from like all those ETFs together. I did think it was probably a good thing that we don't get the ETH ETFs straight out the gates right now, because I think the market actually needs something to delay its gratification to like stop us basically having a blow off top too early. So I think the 2 key things in my mind are when interest rates eventually start coming down in the US, that's going to be a nice kick, I think, for crypto in general. And then around the ETH ETF specifically, that's going to be a very interesting time for Ethena, because we're obviously sitting on the other side of that trade where people are coming in on leverage to speculate on that. And I think there's just going to be interesting dynamics that we can sort of capture going into that event.
What do you think is going to be the event that marks the top of this cycle?
Probably the ETH ETF on the day. is probably my guess.
Interesting.
Or maybe the Eigenlayer token drop as well.
Local top or complete cycle top?
I think it's not even a concern with Eigenlayer. It's just more so much infrastructure sort of and like projects at the moment. The whole of DeFi is basically just a second derivative now of Eigenlayer points. And so if you have that single event and there isn't something more to sort of sustain it beyond there, like 90% of DeFi sort of loses the financial infrastructure that's been building around that. So I think, yeah, it has the potential. It's obviously so much of the forward expectation of what's going to go on the cycle is on the presumption that something like Eigenlayer is going to be a huge success. Yeah, so it's just that comment was more around DeFi, I think, specifically.
What are you guys going to do in the bear market with Ethena? What's the plan there?
Yeah, I think we want to set ourselves up to be maximally flexible to be able to respond to things. So I think one thing that Maker did very well last cycle was give themselves the option if they want to do something else outside of like the core CDP piece, which they did with like RWAs at the back end of last cycle. That's one thing that I just want to have the option to leave it there for the community to decide if that's something that will directionally where Ethena should go. Because like Ethena's product is going to be very responsive to the cycle, where on the way up, it sort of grows pretty quickly. And if you haven't got like an alternate source of sort of like return that's sitting in there, it has the potential to contract quite a bit, I think, in the bear market. And so I know that goes against sort of like the core narrative around Ethena for being the sort of like dollar that sits outside of the normal system. But I'm also practical enough to say that there might be a period in the bear market where someone decides for 3 to 6 months, you need a different kind of exposure sitting in there. So,
which would be, for example?
Like just RWAs or, holding, yeah.
Do you have an example?
Even like, like projects like Ondo or what Maker have done, just basically just holding T-bills sitting behind the asset itself. Just want to be clear, that's not like something that's a definite right now, or this is all going to be sort of put up and like decided by the community themselves. But I do think it is something that you sort of need to just think about as a fallback option potentially if you do get to enormous size and conditions sort of turn.
What's your takeaway from today's conversation?
It was a good chat. I haven't gone like outside of Ethena ever in a podcast conversation, so that was good. Yeah.
Awesome, man. Thank you so much for doing that.
Yeah.
That was a great
Thanks for having me.
conversation.
Cheers.